So the retained earnings statement is probably your favorite financial statement so far because it's the easiest one to do. On a very basic level, we start with beginning retained earnings, we add net income, deduct dividends, get ending retained earnings, done, okay? None of the complications of the income statement or balance sheet. So when we're preparing a simple retained earnings statement, not a big problem. From the previous topics covered, you know, however, that this time we're going to be making some adjustments to the retained earnings, you know, prior period adjustments, things having to do with changing an accounting principle. So let's see how exactly those work. Okay. So the first thing that we get to as a complication to our retained earnings statement are the restrictions on retained earnings. These are generally reported in the notes to the financial statements. You can have restrictions that are due to contractual obligations, or management can, the board of directors can decide that there need to be restrictions on retained earnings for maybe they're planning a future plant expansion, maybe there's a big debt that's coming due that they want to pay off. What a retained earnings restriction does is it restricts retained earnings. So you have appropriated retained earnings and unappropriated retained earnings. This sends a message to the stockholders that there's a certain amount of retained earnings that are not available for dividends to them. So if you had retained earnings of $100,000 and you were planning a plant expansion of $600,000, and you put a restriction on, or the board of directors put a restriction on for that amount, that would send the message to the stockholders that, yeah, that's not available for dividends to us. Retained earnings restrictions don't set aside any cash or anything else. It really just communicates management's intentions. Okay, most companies are just going to disclose these restrictions in notes to the financial statements. Some will make journal entries as, let's say, show here, retained earnings restrictions. Some might do a journal entry like this, retained earnings and unappropriated retained earnings for, you know, so they would reduce the amount of retained earnings available to the stockholders and have an appropriated retained earnings account. Okay, so retained earnings restrictions, you need to be aware of how those are handled and what they are. Prior period adjustments. These are adjustments that we make to the beginning of our retained earnings statement, and there's a couple of categories of things that cause this to happen. One of them are what's called prior period adjustments. What we do is we adjust the beginning retained earnings, and usually it has to do with errors. So we talked about errors before. If they're discovered in the same period that they occurred, then there's no prior period involved. But if the error from past financial statements is discovered, then we make that cumulative adjustment on the face of the retained earnings statement as an adjustment to the beginning balance. And you have to disclose what happened in the notes. The other item that gets adjusted to the beginning of retained earnings would be the changes in accounting principle. That would have to be shown net of tax. And so those are, let's just see how those work. Okay. So if we have, here's the Portman Company, and if they had retained earnings beginning of the 675, net income and dividends, our basic retained earnings statement would be like this, okay? No restrictions, no prior period adjustments. But if we had the same information, except they discovered that land costing $80,000 was charged to maintenance expense 4 years ago, that would mean that 4 years ago, the expenses were $80,000 too high, and so their income would have been $80,000 too low, and that's all net of tax. So when that happens, we would say retained earnings, January 1, and when there's a prior period adjustment, we have to change that to as reported. Not as wrong, or as we messed it up, but just as reported, okay? was $675. Then we talk about the correction of the overstatement of the expense in the prior period, net of tax. We add that $80,000 back, and then we get retained earnings as adjusted, not as fixed or as corrected, but as adjusted. So these are part of any retained earnings statement where there is any prior period adjustment or other modifications. Then you just, at this point, you get your adjusted retained earnings. At the beginning, you add your net income, deduct your dividends as you normally would. Okay, so the tricky part on the corrections is that you have to make sure that you're adding or subtracting here appropriately. Because if you've overstated expenses in the past, that means that you're going to have to increase your net income because you had too much expense in the past. If it says we understated expenses in the past by $80,000, then if you've understated expenses in the past, your income in the past was too high, and so the adjustment would be down. So those are the things to look out for there. Okay, so that's basically your retained earnings statement. And it would be the prior period adjustments and changes in accounting principle that would be accounted for in this manner. And then if there were retained earnings, you would have just notes to the retained earnings regarding any restrictions.